Quarterly earnings reporting for US-based companies may be going away soon. The Trump administration has been floating the idea and pushing more and more for it recently. Instead of reporting earnings every quarter, the idea would be to let companies report twice a year or every 6 months. Now, as you might imagine, there are some people who think this is the greatest idea anybody has ever had. While on the other hand, you have people who think this would literally destroy the United States. But what's the truth? Obviously, it's going to fall somewhere in the middle, but is this going to be primarily a good thing for markets or a bad thing? Now, if you know anything about me, you know that normally I am all for freedom and liberty. Let individuals make choices that they want to make so long as they are not violating anybody's rights, and let the chips fall where they may. This would be an example of less government interference. Instead of the government going to companies and saying, you have to tell investors specific information every 3 months, they're going to pull back the reins a little bit and say, you only have to tell investors this information every 6 months. So not that big of a change, but a little bit more freedom, which also carries some risks. And that is because regulations and laws always have a tendency to backfire. In other words, they accomplish usually the opposite of the stated intention. And maybe this is nowhere more true than in financial markets. Pretty much every rule and law on the books that is designed to protect poor people, dumb people from making bad decisions and losing their money because they're just too stupid to figure things out for themselves, most of the time, it just blocks those people from having access to the same type of investments that smart people, I mean rich people, do. Take, for example, the pattern day trader rule. The pattern day trader rule states that if you open and close the exact same position on the exact same day, that counts as one day trade. If you do that more than 4 times in a 5-day period, you are now classified as a pattern day trader, and you need to have more than $25,000 in your account in order to continue trading. This designation will follow you even if you move your brokerage account from one place to another, which means if you accidentally get designated a day trader, you will have a minimum account balance requirement of $25,000 everywhere you go. This means that if you are young or a low-income earner or both, it can prevent you from effective investments until you are able to just save up that amount, which for many people can be years. And the insidious thing about this rule is that it's not even required anymore. The reason why the pattern day trader rule was put into place in the first place is because back in the late 90s, when electronic trading began, there were so many small account individuals that were day trading that the NASDAQ couldn't handle the volume of trades coming through. So they just said, okay, if you're going to be day trading, you have to have at least $25,000 in your account. That limited so many people away from being able to day trade that it allowed a lower volume that they could handle. Well, guess what? It's 2025, and there is no need for this rule anymore. Their systems can handle higher volumes of trades. Even if everybody with $200 in their Robinhood account wants to day trade all day long. Everybody could handle it. It is a rule that is just left in place because it was put in place at some point. And there is now an unquantifiable amount of damage that has been done to low income and young investors who were prevented from investing potentially the most effective way they needed to because of a rule that was set in place in the 90s because of a tech limitation. Another example of this would be accredited investor rules. There are certain investments that people who are not accredited do not have access to. Things like private placements or hedge funds. There are many investments that you are not legally allowed to invest in unless you're already rich. Again, these are rules or laws put in place to protect the poor person because apparently poor people are just too dumb to learn about the risks. Have you ever thought, oh, that would have been nice to invest in this company before it went public? Yeah, it was nice for the rich people who are able to do that. And in order to qualify as an accredited investor, you need to have a net worth that exceeds $1 million, which excludes your primary residence, or you need to have an annual income of $200,000 for an individual or $300,000 for a couple for the last 2 years with the expectation that that earning will continue. And if you don't meet these high income or high net worth requirements, you are legally not allowed to invest in some of the investments that have the best performance throughout history. You're only allowed to invest once it's made available to the public after most of the gains have already happened. And so any financial regulations, including quarterly earnings reporting, generally I would be a fan of saying, hey, If the government has less involvement in this, less regulation, usually over the long term, that's going to be better. However, the risk, like I mentioned before, is that anytime you have a safety railing in place, a safety net, and you just remove it, you are almost guaranteed that there are going to be some dumb people who trip and fall and hurt themselves tumbling over the edge. And so if the SEC does allow companies to report every 6 months instead of every 3 months, you will have at least a little bit of this effect in the marketplace. Number one, you have less transparency. There are plenty of companies who commit fraud. And the number one way that that fraud is found out today is by investors digging through the financial reporting, seeing that the numbers don't add up. And if that only happens every 6 months instead of every 3 months, there's a lot longer period of time that bad actors can continue their grift. It also allows for more insider trading because there's a longer period of time before that gets found out. Before the bad news hits the market and everybody else dumps shares, insiders have been able to get out early. It allows companies that are potentially facing the reality of having to report bad news to wait for longer, hoping they can get out of the mess. In other words, sweep things under the rug for longer. And ultimately, it means that we would probably have a lot more volatility around earnings seasons. If they're only happening twice a year, we already have stocks that will shoot up or fall down 2, 5, 10, 20, sometimes 40% on earnings. If it has been 6 months now instead of 3 months since the last time they showed their data to the public, those moves on average would very likely be much greater because the underlying change in those businesses over that time has also been greater because more time has passed for those changes to have been made. All of those risks are real, but it is also true that 3 months going to 6 months is not really that big of a change. It's not like the proposal is to say companies don't have to report at all. There are actually plenty of countries around the world that don't have quarterly earnings reporting requirements. They already only have 6-month reporting requirements. And here's the deal. Insider trading and fraud are still illegal. And so it just means that at worst, it will take longer for people to find out about it. Now, that is bad, but the question is, does that cost outweigh the benefits of going from 3 months to 6 months? And the main benefit here of going to 6 months is that it would allow companies to, number one, avoid the cost of quarterly reporting, which is actually pretty colossal for most companies. You have entire divisions dedicated just to reporting. Every single quarter, all they're doing is preparing for the next report. So it would free up more financial resources to go to being actually productive and growing the company, providing a return to investors, which at the end of the day is what investors want. And if you have a pension or a 401k, you're the investor, you're the owner. So that's what you want. But the real main benefit is that it would allow companies to focus a little bit more on long-term growth rather than just hitting quarterly targets. Wealth loves patience. And the longer you are able to wait for things to grow, the better it will be. And the more you're focused on short-term and what I can get now, the harder it will be to create true growth over the long term. Now, it's true, companies can still focus on long-term growth right now, but the incentives and the motivations and the quarterly reporting and what investors are looking for mean that the pressure is to focus more on the short term rather than the long term. Going from 3 to 6 months isn't going to fix that, but it is a step in the right direction. So the reality is there are real risks going from quarterly reporting to 6-month reporting, and people will get hurt. There will probably be a time period where there will be more fraud, where there will be more losses, more volatility in the markets, maybe more insider trading, but it'll still be found out. The individuals and the companies doing this will be held liable, just like before, and over the long term should have a net beneficial effect for both investors and the companies themselves. And in the wise words of Thomas Jefferson, those who sacrifice freedom to achieve security will lose both and deserve neither. When it comes to freedom and removing or limiting government intervention, the risks are always outweighed by the benefits. And if you want more insights like this, especially hearing me talk about things that I don't post on YouTube, I have a free newsletter. So if you'd like to see me in your inbox every week, go ahead and click on that link in the description below, and I'll see you there. As always, thanks so much for watching. Have a great day.